Hey guys, Jason Sharon here, the owner of Home Loans Inc. Here to talk about the dirty secrets about mortgages that loan officers don't want you as realtors to know. Who am I? I'm the owner of a small little boutique mortgage brokerage here in Charleston, South Carolina. I'm a Christian, husband, father, kids spread from 21 years down to 16 months. I started all over. I'm a speaker, author of 3 books on mortgages, and I've been featured in Forbes, Yahoo.com, Yahoo Finance, Money.com. Um, First, dirty little secret that we don't want you to know. Every loan nearly dies. No kidding. Yes, I'm 100% accurate. Every loan nearly dies. And the reason why is the government, when they wrote the requirements for mortgages, wrote them so loose and so squishy that a lender can turn down anybody for any reason. Obviously, they don't necessarily want to, but they can. Um, Even that little sweet old lady that's putting 40% down with an 800 credit score and fixed income, something can go sideways on it. The title has an issue, the insurance has an issue, the appraisal has an issue, the earnest money is weird. There's some issue on every file. We don't tell you because you're going to freak out if we told you every file almost dies, but it does. Second dirty little secret, we know we need you realtors, but we wish we didn't. We really want to generate our own business. We don't want to, I don't want to be there going, loans for the poor, please give me a loan. But unfortunately, just the way that the real estate ecosystem works, we're just further down on the food chain than realtors are. And just like insurance agents are further down the food chain than I am. Like I don't expect to ever get a referral from an insurance agent. I would love it. I send a ton of referrals to insurance agents, but I don't expect to get anything back in return. And vice versa. We would love to send you referrals. We just don't get that many buyers that don't have an agent associated with them already. And if I do get a past client that refers somebody to me, which happens a lot, 30% of my business last year was past client referrals, I give that new client to the realtor that originally sent me the client that referred him to me. So that way I'm giving back, as much as I can. So just get that. We want to help. We want to send business to you. We just don't get that much. Third dirty little secret that we want to tell you is you don't know what closing cost, and neither do we. What we need to do is convey a message of empowerment to the client when they ask us closing costs. They just don't know. They know to ask, but they don't know that it's their choice, right? Closing costs are the sum of all the choices the client makes, right? So, like you asked me, hey, what the closing costs would be? Well, who's his insurance going to be? How much is his insurance policy going to be? Who's he using for a closing attorney? What's the title charge going to be? Is there an HOA buy-in fee? How much is his insurance going to be? It's all that stuff. How much is the title insurance going to be? All that stuff added up together gives the answer. So whenever you get asked that, just empower the client. Hey, it's going to be 2 to 3%. It'll be lower with me, closer to 2% because there are no origination fees with me. But if you're using a lender that has origination fees, that's going to add to the closing costs as well. So explain to them, empower them that it's their choice, but it's going to be about this estimate. Fourth dirty little secret, you don't know as much about mortgages as you say you do. That might make some of you mad. I'm not trying to belittle your experience or talk down to you. I truly am not. There's so many things about the real estate world that I don't know. I'm like, I don't know how to deal with EMD that the seller doesn't want to refund. I don't know how to deal with due diligence extension periods, and I don't know how to deal with dumb MLS issues, post closing that you guys have to do with some silliness with. You may have done a couple hundred deals over the last 5 years, and maybe you crush it. Maybe you do 40, 50 deals a year. Um, I wish you would come spend some time in the office, my office, or your local mortgage broker's office, and spend a day sitting there with the processors and understanding what it is that we do on a day-to-day basis and dealing with waiting on title work, waiting on appraisal, waiting on insurance, waiting on EMD, waiting on whatever. Um, Understand that we're equal team members with equal responsibility and equal roles together, along with the insurance guy, along with the insurance, with the title, with the appraisal, along with title company. We all have our roles. We all need to stay in our swim lanes. Um, you don't know as much as you say you do. Fifth dirty secret: We can't really share their information with you. I know you've got it before. I know your lender sent you the closing disclosure. I know your lender sent you the final package to review. Flat out not allowed. The Graham-Leach-Bliley Act of 1999 expressly prohibits the lender from sharing any personal private information. That includes an address and a phone number and an email, anything without explicit written consent from the client. Now, do I share information? Absolutely. Like I said in the previous, earlier, we're a team. I'm in the real estate paycheck delivery business. I get it. My job is to get the seller paid, to get the listing agent paid, get the buyer paid, or buyer's agent paid, get the loan dispersed, get title paid. I understand I've got to get everybody paid. We can work together as a team, but just realize that I'm not legally allowed to give you private personal information, especially the LE or CD. You might be getting it from the loan officer. They're in the wrong. Here's what you really need to know. So enough about the secrets. What do you really know? Mortgages, they suck. They're tough. They're more of an art than a science. Here's some of the things that you should, best practices, things you should know in order to look out for your client's best interest. There are 3 parts to a mortgage, the 3 C's. Really, everything falls under one of these 3 things. You have character, capacity, and you have collateral. Character being credit score and credit history. I care so much more about credit history than credit score. So someone called up and said, "Hey, I've got this 581 credit score. Can you do the loan for me?" Maybe. I closed a 569 VA loan a month ago. It was due to lack of credit, not due to derogatory credit. I can close at 569. I may not be able to close a 614 if they've got recent late payments. So it all depends about that history. Capacity. Do they make enough money for the new payment and their existing debts? And do they have a high probability of keeping that income and then employment? Right. So it goes back to 1099, self-employed borrowers, overtime, commission, um, bonuses have to have 2 years history on it to show that it's probably going to continue. Then collateral. Do does the property is the property worth what they're paying for it, and is it clear and warrantable, or do they have enough assets to meet that appraisal gap? So that's the basics. Keep that in mind. If you ever have an issue on a deal, it's going to fall under one of those, and start talking to a loan officer about how to solve it. If you get nothing else out of this video, I want you to understand automatic versus manual underwriting. This is where the rubber meets the road. This is where loans go to die. If the loan officer doesn't understand this before the pre-qualification is issued, you've already lost the fight. It's not a deal. This has to be done prior to pre-qualification. AUS, automatic underwriting system. It's a computer algorithm that we submit the file to, and it takes 3 minutes. It's nothing at all. We submit the file electronically. Credit history, credit report, the application. It slices that file into multiple different layers. Credit score, credit history, assets, income, loan to value, debt to income ratio, employment history, and then assigns a risk factor to each one of those, then adds them all up and gives one of 2 responses: approve or refer. Let's talk about those responses. Approve is what you want. It's an easy peasy loan. Give that guy his keys. Just make sure all the documents in the file match. Basically, the underwriter does not have to make a credit decision about the client. Is he going to pay or not? The underwriter doesn't have to do that. The underwriter just has to make sure the documents are legible. They're not too old. They're not missing pages. They're if there's large deposits, they've sourced them. They're just dotting the I's and crossing the T's. Refer. So these are the tough loans. I closed 40 of these last year. Basically, if you get a refer, the underwriter has to make a decision of, hey, is this a good credit risk? Or are they going to pay back the loan? I've put together the 5 things that if you meet these 5 things, I've not lost a manual underwrite. No late payments the last 12 months. Zero, zilch, nada. No late payments. In the last 2 years, you can have up to 2 30-day late payments on the credit report. So last 12 months, no late payments. Over 24 months, 2 30-day late payments. not a 90, not a 60, not 120, up to 230 day rates. Stable job history for the last 24 months. Not a job hopper, not frequent job changes, no big gaps. Stable job history. Verifiable rent history for the last 12 months. So if they've been renting from an apartment complex, you got to show that they pay that apartment complex every month on time for the last 12 months. If it's a VA deal, 24 months. They need to have 2 to 4 times the new mortgage payment in savings. So let's say the new mortgage payment is going to be $1,500 a month. Then they need to have $3,000, maybe $6,000 in the bank on top of closing costs and on top of down payment. And that money doesn't go anywhere. They still keep the money at closing. It just shows they don't live paycheck to paycheck. If you got those 5 things, I can get the loan closed. VA loans are not inferior. Please, please, please absorb this and then give this away to as many other your coworkers as you can. They're actually a better choice for you and for this seller. As long as you've got a good loan officer, they're a better choice. Right? So the first thing is the appraisal has 2 formal rebuttal processes to follow. Nobody else, no other loan program has that. They're statistically more likely to close than a conventional loan by 4%. That was 2021, the number of applications versus number of closures. VA loans closed 4% higher, statistically 4% more likely to close than conventional. They only require 1 underwriter. Did you know a conventional loan with 5% down requires an underwriter for the loan and requires an underwriter for PMI? That's twice the number of underwriters that are picking apart that file than on a VA loan. If there's an appraisal repair, the veteran can request a waiver of that. FHA and conventional cannot. Guidelines are truly written to give the veteran the benefit of the doubt. That's in the very first part of Chapter 4 of the guidelines. It tells the VA underwriter to give the veteran the benefit of the doubt. Fannie and Freddie don't do that. There's no minimum credit score and no maximum debt to income ratio. A lender may have overlays or red tape, but truly there's no minimum credit score and no max debt to income ratio. Most vets have money to put down for down payment. So even though they're doing 100% financing, they've got money. What that means is if the appraisal comes in low and they have to make up a difference, they've probably got the money. Whereas that conventional borrower, they might be using all their money for that 10% down payment, 20% down payment, and have no further room for that appraisal gap. There's no loan limit, although eligibility can play a factor, right? FHA limit is per county, and conventional is based on the county as well and changes every year. Don't we really want to fight for vets to own part of the country that they fought to defend? Of course we do. FHA loans are just not for first-time home buyers. Lowest FICO is 580 with 3% down. You can actually go all the way down to 500 with 10% down. I've got lenders that go below 580. Highest debt to income ratio limit of 56% with compensating factors. Lowest down payment with no income cap. You can go down to 3.5% for down payment. It has more appraisal minimum property conditions than a VA loan. That means that it's more restricted than the VA. Most people don't realize that. They're more lenient on collection disputes than conventional and USDA. FHA flip rule. If you don't know what this is, you need to understand it as a realtor. If the seller of the property acquired the property within the last 90 days, then you cannot write a contract on it, not till day 91. If the seller acquired it day 91 to day 180 ago, and the price of the house doubled, then you need a second appraisal. The buyer cannot pay for the second appraisal. And if the second appraisal comes in 5% lower than the first appraisal, you're limited to that second appraised value. PMI is permanent on FHA 99% of the time. It's 0.85% per year divided by 12 added each payment. Upfront PMI is 1.75%, which is added to the loan amount. And like we talked about before, loan limit is county specific. First-time home buyer programs are generally bait and switch. The true first-time home buyer program that was really, really good was passed by and expired under the Obama administration in 2010. There are plenty of lenders advertising them, but that's just their internal thing to get the phones to ring. Fannie and Freddie both have a 3% down conventional loan program for first-time home buyers. That's defined as someone who has not owned a house in the last 36 months. And there's even exceptions to the 36 months. There are income caps on those programs. If you qualify for them and cannot put down 5%, they are good. Otherwise, just use a normal conventional program. And as we all know, nobody gives away free money. Down payment assistance are usually not good loans. Higher fees, higher rates. USDA is not just for beef. Sorry, corny joke. This stuff can get boring. There's two types of USDA programs. There's USDA Direct and USDA Guaranteed. USDA Direct is just that. It comes straight from the USDA. If your client can qualify for this program, you should make them get this loan. It is amazingly good terms, amazingly good rates. It's really, really good. I've not seen a USDA direct loan that wasn't just an amazing opportunity for the client. USDA overall is no money down, no minimum credit score, but it's nearly impossible to qualify for less than 640. Low upfront PMI, only 1% versus US FHA of 1.75, and has lower PMI of 0.35%. Income max is based on family size and county. Must use the spouse income even if they're not on the loan, and that could cause an issue that routinely does cause issues. It's got the lowest allowable DTI, 29% at front end and 41% back end, with some exceptions on super strong files. You cannot own any other properties. If you can put down 20%, if the client can put down 20%, they will not qualify. Must go to USDA for final approval, which can add up to 2 weeks to the closing. And there is no loan amount cap. It's just based on debt income ratio. Who are Fannie and Freddie? No, not your nosy neighbors. They are the private companies currently under government control since 2010 that set the guidelines for conventional mortgages, which will get bundled, called securitization, and then sold on Wall Street. Sometimes Fannie is more lenient than Freddie, sometimes the other way around. A lot of times they match. Minimum credit score is 620, but usually if you're below 700, we're going FHA. Minimum down payment is 5%, and we previously talked about a special 3% down program. Loan limit in 2022 is 647,200. This appraisal is horrible. Nope, no, it's not. There may be some issues with it. Is that appraisal trained and licensed to write contracts and negotiate? Can they do listing presentations? No, they can't do your job. You're probably good at CMAs, but appraisals are significantly more complex than a CMA. CMA is one, two, three, maybe 5 pages for an amazingly technical one. Appraisal is 50 pages. There's so much more. Did you do a 200-hour course? Yes, 200 hours is what the appraiser has to do before he even starts his internship. Did you do 1,500 hours of on-the-job appraisals in 1 year? Yes, learning under a certified appraiser for 1,500 hours, right? That's 30 hours a week is what their training is before they get to do their first appraisal. Did you do the appraisal license exam? No. Appraisers, am I trying to demean you as an agent? No. I'm trying to explain how valuable and how important that appraiser is, and about what their training and their certification and their all the stuff they went through to get to be that appraiser. Do they make mistakes? Yes. And something you probably don't know, I should have done as another little secret. Every appraisal has an issue. I can't remember the last time an appraiser's come and the underwriter has looked at it and not found an issue with appraisal. It gets sent back to the appraiser to fix it. It may be missing a box checked. It may be adjusting why did the comp get adjusted by $5,000 where it should have been adjusted for $3,000. There's something wrong with every appraisal. It gets fixed on the back end and you don't normally see it. Appraisers get judged and graded on every appraisal. Way beyond the scope of this, but Fannie Mae's collateral underwriting system measures their adjustments to their historical adjustments and their peers in the area. It checks a lot more than that as well. Yes, and this is such a horrible myth. Yes, VA and FHA buyers can pay over the appraised value. Condos suck. Yes, they do. That's the name of the condo chapter I wrote in my book. USDA need not apply. VA and FHA have to be on the approved respective condo list. Most are not approved. Conventional loans require a condo questionnaire, which basically underwrites the condo regime. Are more than 50% of the renters, occupants renters? Denied. Are more than 50% of the owners behind on the regime fees? Denied. Do you have at least 5% of the annual budget in reserves? No. Denied. Is there pending litigation? Denied. There are 7, now 8 pages of questions that the regime has to fill out. Don't trust the listing agent that that house is a townhome. Go to the county tax records because the listing agent probably just listened to what the client said and listed as a townhouse when it really is a condo. And the new requirements is their deferred maintenance. Remember that last year, whenever that horrible tragedy in Miami where the condo collapsed and killed 21 people? That was due to deferred maintenance, and that was not a surprise. The regime knew what was going on. They knew that those repairs need to be made, and they chose not to make them. That was horrible. Those people are criminals and should be locked up. But let's be honest. There's new requirements for condos, particularly high rises. Real estate, manufactured homes, mobile homes. So much misinformation on this. Manufactured and mobile homes are interchangeable terms. This is different than modular. Modular homes are treated just like traditional stick-built homes. Mobile homes were created in whole or halves in a double wide, registered with the DMV, and then towed to the location and set up. A mobile home must be detitled from the DMV and then registered as real property with the county to get a mortgage in order to get a mortgage. Must have the wheels and tongue removed, must be set up on a permanent foundation. FHA requires an engineered inspection. That's an actual engineer, not a technician, not an assistant, actual licensed, professional licensed engineer climbing under the mobile home and checking to make sure the tie downs are at the right angle, the trusses are the right distance apart, the footers have the right square inches. There's just so much to it. That's an additional inspection, usually costs about $500. Now that's only for FHA loans per the guidelines, but most lenders, if they choose to do mobile homes, will require that even for a conventional or a VA loan. USDA will not do mobile homes except for if it's a new mobile home that's never been occupied. There's a pilot program in 7 states that they're working on, trying to see if USDA works for used for previously occupied mobile homes, but that's not rolled out to most places yet. Other things that I see messed up, the red HUD tags, which are down by where the tail lights used to be, they have to be there. If they're missing, you have to get a replacement certificate for a couple $100. And it must not be moved from its original location. So it's brought from the factory, set up at 123 Main Street. Somebody lived there for years, and then it moved to 456, Brown Street. Can't get a loan on that. VA has some exceptions to that. Mortgage broker versus direct lender versus depository lender. So a depository lender, Wells, Navy Fed, Bank of America, do you want fries with that mortgage? Sometimes they have special programs called Community Reinvestment Act loans. This is where they got caught doing something bad and they had to give back to the community in the form of some type of advantageous mortgage. Direct lender, usually more skilled than the depository. They are generally referral based, so they have to be. They usually have higher rates and they have origination fees. Brokers, we are wholesale. We represent the buyer. Personally, I'm set up with 54 different lenders. We manage the loan from start to finish, except for the underwriting. Therefore, we have wholesale rates and no origination fees. Therefore, your clients can qualify for more with a lower rate and have less closing costs and no origination fees. How to find me? Here's my address. Here's my phone number. Here's my email, 843 low rate, jason@homeloansinc.com. I'm basically licensed in the Southeast. South Carolina, North Carolina, Virginia, West Virginia, Florida, Georgia, Alabama. Got a question? Give me a call, 843 low rate. Great. Thanks for watching. Bye.